Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, May 20th, 2021. What I'm going to do in this video is start out, as we usually do, looking at the broad markets and kind of looking at the near-term outlook. But I want to make very clear my differentiation between the near-term outlook and things that I'm going to do there, and the longer-term outlook. And what I mean by that is, this is what I call microanalysis, trying to identify the zigs and zags on the way down, where snapback rallies are likely to be capped. In other words, objective bounce targets, whether you're trading long off support or looking to short, and then levels that, if broken, like support like that, are likely to trigger the next wave down. So that's again microanalysis, because these little micro trends last just hours to days, and so I wanted to make clear, because sometimes I talk about those. Well, I talk about those levels all the time throughout the day, but then bigger picture. Again, I've talked about this, that my focus is shift to the longer term charts based on the developments we have. For the first time in many, many months, we have breakdowns and sell signals across all the major indexes on the more significant daily charts, and I'm referring to those primary uptrend lines. This is a very simple view of it right there. We're still below it. So where I'm going with that is, if when I enter, and I wear multiple hats. I'm a day trader, I'm a swing trader, I'm a trend trader / investor, all of the above, multiple accounts. And in different accounts, I'm doing different things. Active trading account, I'll game zigs and zags, and I'll trade off the, even down to the 1-minute charts. That stuff's usually too quick to, post on the site. The 1-minute charts, those trades are in and out, sometimes less than 1% on a price target if you're trading futures. And then swing trading again, and trend trading. Right now, I'm looking more at swing trading, and these sell signals, I just wanted to reiterate before I get into the video, are still very much intact. I'm talking about the recent breakdowns on all the primary trend lines off the March 2020 lows on all the major indexes. Now, some of those have worked. They all have work to be done, and that's what this video is going to be about. I'm going to concentrate on two of the sectors within the S&P 500 that I've been watching very closely and talking about for a while now. And that is the financials and the industrials. As I continued to state, the market is not going to break down and have a decent correction. I'm talking the broad market. We've had a pretty decent, very tradable correction in the NASDAQ tech stocks, and lately I told you I kind of shifted away from there because we've milked a lot of the meat off that bone, I believe, and dip buyers are stepping in as to be expected, and particularly because the broad market hasn't broken down. And so far we have pretty much tech correction that stalled out the S&P 500. And we're on the IWM here. I'm just talking about what's going on. And until we see the majority of the big sectors, there are 11 sectors in the S&P 500. Tech's broken down, but I need to see the financials and industrials, among a few others, but mainly those to break down. So we're gonna roll into that in a second. And then things like IWM, yeah, we broke the trend line, but we hit some pretty big support here. That had this number here, about 211.75. That's been pretty much containing pullbacks now for a while here from a horizontal price level. And if you look at this, and I always incorporate, there's a lot I incorporate into my trading I don't always talk about, but the volume price histogram is one thing. And it shows you, as the name implies, these bars indicate the amount of volume at a given price. So down below, and these are really tuned down, you can't see my volume bars are down here. Volume bars on a regular chart at the bottom show you the volume on any given day if you're on a daily chart, which there are. Again, I have it turned down because I just don't like busy charts. I can see it. You might not be able to make it out in the video, but there's volume bars down there. And then the volume at histogram bars, again, I keep those tuned down so it's not, my charts don't look like a Christmas tree or a rainbow. But this tells me right here, over the last, however far back we're going, so I have it, let's just scroll back to the March lows right there. Okay, so we'll roll back, there's where we bottomed, and so that's right after the March lows. And so what this volume at price histogram tells you is how much volume, or the number of trades, were made at a certain price. So this tells you right here, this is a big level for the last, and you can see, I mean, when you go back in time, since the beginning of the year, this was January, we broke above that level, and the vast majority of trades over the past year, over a year now, have been at that level. So that's a big level. And the way technical analysis works, you know, if we can power through that trading range up, that's bullish. But you break down, that's very bearish. You have a lot of trapped buyers, a lot of trapped longs in, for example, IWM. So there's a big level for me, and that's again that 211.75-ish level. And I also have an uptrend line. And where do we go from there if it breaks? Well, one gauge to try to figure out where we go is you look at these levels act as support and resistance, these big bars. So this is a thin zone all the way down to about right here, and that shows you if we were to break that level to the downside, that's one potential target. Now I may sharpen my pencil and have additional targets on there, but I would say based on this pattern and everything that's gone on, that's a logical swing target. And that would be, you know, roughly about 159 on IWM. That's about a 27% drop if it happens. And right now, again, we're on a sell signal, but not an all-in sell signal. By all in, I don't mean you put all your money into a short position in the market. No, all in just means if I'm gonna swing trade or you know, trend trade a position, whether it's gold or corn or you know, equities or a certain sector, how much of my portfolio am I willing to allocate to that sector? And there's many factors that go in there. Never 100%. But in this case, if it is, let's say I want a 50-60% exposure to the equities as a whole, then that's my all-in point. And until then, I don't think it makes sense to get aggressively or fully short to that point. Hopefully that makes sense for you there. I like to, for example, long gold and other things like commodities, things like that. I've tempered down my commodities lately. I'm refraining from buying on the pullbacks at this point in time, as I talked about. But I'm just trying to give you an example. Trading, just like investing, the most important thing in investing is asset allocation. That's having your portfolio diversified among different asset classes and different positions. And so that's what a portfolio should look like. A certain amount to whatever, precious metals, PM, and a certain amount at any point in time. Maybe you're in bonds, maybe not, commodities, and then within the commodities pie, how does that look? So that's what I'm talking about. And so on an all-in portion, if you say, hey, I'm going to be 60% short equities once we get some solid sell signals, that would look something like this, a little over half, and that would be your short equities portion of your portfolio. And then whatever else, you might have your flight to safety assets here. Could be gold, silver, and the mining stocks. Could be treasuries at the time if there's a buy signal. Somebody asked about that in an update in a post yesterday in the comment section. I will get to that. I'll do an update on treasuries. But right now, the point of this video again is to talk about the markets and those sectors. And let me get moving here. Like I say, I'm not trying to digress. These are important things that I'm watching for, and it kind of gives you my overall view on the markets where we're at right now. And that is just a little more work to be done on quite a few things, particularly these sectors I'm about to get to. Let me just turn off these volume of price bars. Turn these down like I had them before. So I put them to the point where I can make them out, but they're just not too busy on the chart. All right, so there's IWM, and again, SPY have broken down, but a pretty important level there, about 404, needs to be taken out. And then QQQ also below the primary trend line right there as well. And now when we drill down into the shorter term charts, I mentioned QQQ was at this trend line resistance, and it was really more of a potential trend line. I should have made clear. I figured we'd get a reaction there, and we didn't, and we went through it. So that's not actually a validation for a trend line, because in my book it takes 3 distinct reactions to validate a trend line, because any 2 points can be connected at random. In other words, right now we have another potential trend line should we reverse right here, but that would just be a random second point. However, we're close enough that if this 60-minute candle reverses, and there's that big 330 resistance level, we could close down through there. Now, I mentioned, and here's what I wanted to talk about. This is why I kind of went off a little bit of a tangent to the long-term charts. I mentioned this morning, and I've said several times, depending on where if you short, like for example, if you shorted that trend line today, and it is a little more distinct on NQ, I'll get to that in a second, that you could short there with a relatively tight stop above 330. Is 330 my out of the market, out of short position? No, because this is where we first got our sell signal right here on this breakdown, and there was an early sell signal before that on that breakdown there. And so one's cost basis might be up here, could be up here, it could be anywhere, it could be down here. So again, that's just an objective area for relatively tight stop if you shorted this bounce back to the trend line. At this point in time, am giving more room and not even concerned with what happens today, tomorrow. We'll see into next week. We start to really take out some of these previous highs. What happened today doesn't help the bearish case at all, but we took out this previous reaction high right here. The next distinct reaction high is right here. And so does this right here eliminate, the case saying we're going to new highs? Absolutely not. It doesn't help the bearish case, but again, nothing at all, not even close, has changed on the daily charts yet. I still have those sell signals there. There'll be some additional sell signals to come that will increase the odds, and then at that point, I'll even go to a more aggressive short position. I just want to say for the time being, I'm giving my swing index shorts some room. And then here's SPY. SPY had a little bit better. I added this trend line and I posted it in the comment section after this morning's post. This was a little bit better trend line because we had 1, 2, 3 distinct reactions, but we went right on through it. But we're right back to that previous bounce target zone, which was and still is resistance. It's where we failed before. There's a big old gap right there, and that's where we're at right now. And here's your previous reaction highs, one there and one there. So we're right about at that other one, previous reaction high right there. And there's one that would get taken out. And again, so here's how it works. You take out that previous reaction high and then that gap resistance, and I can only give a check mark in the near term to the bulls if that happens. But based on what's happening on the daily charts, those sell signals, I'm hanging tight. I'm not going to get whipped out. These markets are just known in recent years, really for the past decade or so. The algos have gotten so smart, algorithmic trading programs, knowing where stops are, logical stops, and they're geared to take advantage of that and really just suck money out of the market, And so when I get longer term sell signals, then I will watch these charts. I'll use them to micromanage my trades, but I'm putting a higher preference on what happens on the daily time frames than I am on the intraday time frames, because we can come all the way up here. We could do all this today and then turn around and then go back down and close the day back below this bounce target zone or that reaction high there. And again, it would take a lot, particularly a recovery of the primary uptrend lines on the daily charts, to change the outlook on that time frame. Wow, okay, that was a lot. It gives you my thoughts. Let me look at the futures real quick, and then we'll move on, and I'll just kind of brush over those sectors since I've already spent so much time talking about kind of big picture versus short-term picture stuff. But I do want to get to the industrials and the financials. Here is the NASDAQ 100 NQ, and just like QQQ, actually we did only have also 2 reactions. The high right there and this reaction, although right now if we reversed and close this 60-minute candle down there, we are going to have a reaction on that trend line if again we reverse and start to move lower. So there's one to watch. Resistance just overhead at 13,540, and let me zoom in a little tighter there. And again, does it help the bearish case to see this previous high taken out in that one? No, it certainly doesn't. But however, there's still, by this metric, a wave down, a wave up, a wave down, a wave up, we could still be in a downtrend, a primary downtrend line, and maybe we come in like this now at this point in time and set up a new downtrend line. So again, let me say this too. Based on the fact that we've taken out these 2 previous reaction highs, and that level at this point you might want to not add to any shorts if you already have a pretty good size, good position size. You want to see some type of reversal, but let's see how this happens. Maybe I'll loop back to it at the end of the video and see how this 60-minute candle closes. And there's ES right back to this former support, now resistance zone right there, and you see a lot of reactions on there in recent weeks, especially these previous two reaction highs. So, and again, remember, my focus is shifting. I'll watch the Qs, but now at this point in time, I think it's much more important what the S&P 500 does, because the Qs have already broken down. They're clearly in a downtrend. They're well off their highs. They've had a much more bigger correction than the S&P 500, the broad market. And so right now, the broad market has yet to take out the previous reaction highs. We have a leg down, a leg up that came to two equal highs, so that's just one leg up. Leg down there, it did fall a little shy of that. Would have helped to see it undercut that, but right now we're below those previous reaction highs. So let me draw a trend line here as well, and to add on ES, and that's it. We're pretty much right at that. Remember, we're just a hair above it, and again, depending on how this 60-minute candle closes, we may close down on or under that trend line. So that's what it looks like on ES, the S&P 500 E-mini futures. Okie dokie, now on to the two sectors that I wanted to talk about, the financials and the industrials. This is my XLK daily chart. This is a busy chart, so I'm going to show you a clean board, but the most important thing is we've been like just about everything out there, divergent highs, growing, bigger and bigger, the divergence building. But when I flip over to this clean board, let's just look at the most important development on there right now, and that's that primary uptrend line off the March lows, like the market in the indexes I showed you earlier. And then you zoom in nice and tight, and you see we recently broke down below it, but not very impulsively right now. We did have a pretty decent drop yesterday, but we are below it. So I'm going to call a spade and say this is a sell signal unless the trend line is recovered. Maybe it is, maybe it isn't. So, but for now, let's take it on face value. That's a breakdown. And I guess when we're on industrials, I'll just show you a few other things. So let's look at a few of the big names here, and I'm just going to rifle through my charts. I don't have them all marked up, but these are some of the components of XLI, the industrials ETF. And so the ones I'll stop on, the ones that I see some pretty clear developments. There's Honeywell. It's broken down below the primary uptrend line, but it has big support there, about 216.33. It hit it the other day. So this is one of those cases of what I call a BOD line. Yeah, you had a trend line break, and would I have jumped in heavily short to Honeywell? No. Why? Because this was a big level, and still is, that 216.33. We hit it, and so far that's held support, and it's made the breakdown not very impulsive. Normally, when a market is so frothy, and I have these indicators at extremes like I do, extreme bullish sentiment, extreme low, put to call ratios, all those indicators, usually when the dam breaks, you get just a fast, or what I call waterfall sell-off. And guys, I strong as the market is today, I still think that we're on the verge of that. I wouldn't spend all the time talking about this, so just get ready. And when is it going to happen, or if it's going to happen, will be when we start to see these two sectors break down, and some of these stocks that I'm covering. Many have already broken down, like Honeywell, for example. And again, the common theme is these big divergent highs. The last time we had negative divergence here was back here, heading into this huge drop into the March lows. And again, okay, and where are we going to go? That's the other thing. How big are we going to drop? I'm just going to, on a lot of these, I'll highlight my minimum targets or my likely targets. That's about a 12% drop to my first target and about a 16.5% drop to the second target. UNP, look at this beautiful bearish rising wedge pattern. One of my favorites. You get a nice, very nice, clean, well-defined uptrend line. Very nice support right there. That was a major reaction high. Once we broke above it, we've been back testing it for months now, and it's about 219, and it comes in right with the trend line. So I feel like I could just, when you're little kid and your friends sitting on the edge of the pool, the water's cold, they don't want to go in, you go just give them that little nudge, and you don't even have to push them hard because they lose their balance and they're going to go forward. That's what I feel like we need right now in the market. Just a little nudge, a little more downside should do the trick to break down a lot of these stocks that have yet to break down. So the theme is I'm seeing quite a few that have broken down above well-defined support levels, but the problem is they had additional support just below. For example, like the last one, broke trendline support with price support below, but this is right here. And if this one breaks down, you know, another couple percentage points down, just one bad day, it's going to take out two key support levels, uptrend line in 219 in one fell swoop. And you can see what happened. Look at this. This is an identical pattern back here. You know, that drop into the March lows wasn't arbitrary. You know, am I going to argue that COVID, you know, didn't play a big part into that huge drop and how fast it happened? Yeah, but it was also priced in. A correction was coming. The trend line was there. We had sell signals across the board, and you know, and the technicals were almost identical. You know, divergences, and there was a big drop back here. Even during the strong bull trend, we had a very fast, powerful 18% drop in UNP, and I expect not much less than that now. So if we break down, get a sell signal, you can set an alert. I have it at 218.95 is where that target is. My first drop, first target 6.5% or 6%, we'll call it, and then down here about a 14% drop. Boeing, I'm not crazy about it. It's already broken down. So again, it had the same thing, divergent high. There was a trend line. Once it broke, it's been in a downtrend since. That was our divergence right there. RTX, Raytheon, wedge pattern, clean uptrend line, pretty clean. This one, what a beautiful chart. Caterpillar, CAT. Look at that trend line. Wow. Well-defined, numerous reactions along the way, not a single violation, negative divergence, and then BOD support at 224.15, you know, benefit of the doubt. It's been walking up. Look at that 50-day moving average. Wow, what a good job. Look at how many times this stock has touched the 50-day and bounced. And so the way this works is both humans and machines are looking at that 50-day. When that 50-day is violated, if it's taken out by a good margin, especially now because it's been a you know, level to watch recently, sometimes you trade through it. But even then, for a quick trade, here was a violation. Here, I think you can see this. Sometimes I forget that on the video I got to zoom in a little bit and show you. Let's grab this 1 second, bear with me. Okay, we're just going to go back to this point in time and just show you, you know, how it works. Here's a 50. It acts, once you break it, it's resistance. Bounce, bounce, a rejection. Boom, big green candle through it. Not a little candle, big candle, and then you're above it, and it's bullish. Pull back, you buy it. Pull back, you buy it. But guess what? Breakdown, red candle. That's a sell signal. Tried to regain it for 3 or 4 days, couldn't. Boom, drop. Came here, came back to it. Had a couple reactions for 2 days, then broke above it, bullish. Came back to it, test. 1, 2, 3, 4, 5, 6, 7th day was it. Couldn't hold it, and it didn't just like limp down. When it gave way, the dam broke, and the stock dropped from the time it broke the 50-day. It dropped about 7% in just 3 days. Now look, it's traded through there. There was not the best. Well, those are decent examples, but once it clearly. Sometimes you get in these little whipsaw, and remember, cat's in a sideways trading range, and this is when moving averages will kind of chop you to pieces. You want to just ideally focus on the bigger trends, and then during a bull trend, you pull back, perfect tag of it. And then guess what? Boom, see that red candle down through it? Breakdown, back test, rejection. All right, I think you get the point. I don't know where that chart just went, but let me go here, back to it. Okay, enough. I don't want to beat a dead horse, but again, so you can see, and this is a good trend, and numerous reactions back to there. And now, why am I beating up on the 50-day or talking so much on it? Again, because it comes in perfectly with a trend line. So where some eyes are watching the trend line, other eyes are watching the 50, and therefore, when it breaks, and then some eyes will be watching this 224.15 level. And based on my experience and my read on this chart, I think a breakdown is imminent. I think it's just a matter of time, more of a when, not if, in my opinion. And that when, if it happened today, that's a 15% drop from where we're at to my first, or from breakdown to my first target. And my next target, final target at this point in time, would be about a 22% drop. And I can go on and on and on, but the video will go forever. I'll just rifle through to see if I have any more of these marked up. Yeah, John Deere already broke down. Beautiful uptrend line. Breakdown. Look at that. Look at this. Breakdown. Big red candle right here. Back test. Rejection. Right down to the BOD support. 352.21. So my common theme is we're sitting on, I think, the edge of a cliff. I know, I imagine most eyes don't see it. This one, oh, look at that. Took out the 50-day. It's been doing a great job of acting as support. Now we're trading below the 50-day on John Deere. Since this uptrend really got underway about right here, pullbacks to the 50 have contained it, and now we're under the 50. So there's one that's on a sell signal. But do you short it right now? No, you short it under today's lows. Today low was 350.53. There's that 352, we'll call it support. That would open the door to the next level down. All right, so you get the picture. I don't have all these marked up, but I'm going to go over to one more thing, and then we're going to get to the financials and wrap this up. Oh gosh, look at this top on FTX and the weekly. Big divergence. So you don't usually get big weekly divergence this big. Last time we had negative divergence on the weekly was back here, and that was good for a drop in FedEx of about 35.5%. This is a big divergent high, and I'm sure we could put a nice uptrend line right there. And anyways, let me get back to where I was trying to go. Obviously, I love charts. I get a little excited over them. XLI Industrials. This is what I wanted to share with you. This is how it looks on the weekly chart. And to keep it very simple, if you wanted a sole target, although I gave you some along the way, and I think we probably have a little hiccup here around 90.21 or so. That would be a minimum target, but this is where I think we come down to from where we're at now. Actually, I measured from the high last week. This one already peaked so far. We're not far off it, back on May 10th. And I'm calling from that level a 20% drop. I just want to kind of gauge how much I think the market is poised to correct, in case I'm making your head spin with all these short-term levels, near-term levels. If you're a swing trader and you're trying to gauge how much the S&P or this sector will drop, well, 20% is what I'm looking for in the industrials. And then XLF, the financials peaked so far on the 10th, I think it was 10th or the 7th, and I'm looking for about an 18% drop down to 31.35 right there, and or the trend line. They both come in together. That's my pullback target right there. Like everything else, or at least these two, that's where I wanted to roll into the financials and industrials. They need to break trend and or any of these minor support levels below. This is XLF, financials ETF. Beautiful uptrend line, nice and clean, a lot of reactions on it. Put in a divergent high recently, and we're just right on the edge. And again, based on everything I see in the charts, it appears that a breakdown is imminent. And minimum target, and this is the first target, more so of support, and that is, how far down is that? 35, 33 from where we're at today. If I can hit that candle, which I just did, that's about a 5% drop. If and when that goes, which I believe it will, then next stop is about 12% drop down to about 32.83, and then 35.31. And again, maybe all the way down here, depending if things get really ugly. Let's just, for this point in time, let's just leave it at this 35, 31 target is my preferred swing target, based on this daily time frame, that is. And that would give me that about a 16% drop. I think I said about 18 on the weekly chart, so give or take. And that should line up with the S&P as well. When you look at the S&P 500, there's my target right there. Minimum target about 356, and that would be from the peak on, it was May 7th. The other two sectors I just showed you were May 10th. That's right, industrials and financials so far. The highest I got to was on May 10th. The S&P 500 peaked 3 days earlier and has dropped, I'm calling for a 15% drop from that level. And that's also my common theme, is that the industrials and financials have held up and kept the market up. And until we see those break down, we're not going to see much downside in the market. Just to look at some of the stocks in the financial sector, JP Morgan, look at all these trend lines, and you can see that most of them are above trend. Bank of America, Berkshire's flirting with this minor trend line. This one is Wells Fargo. Wells Fargo's just starting to crack. Needs a little more work. Citigroup, see common theme here. They're all above trend right now. Financials are strong and holding up. And as I said, we're not going to see a big drop in the market without the financials going down. Schwab, right there, on very close to the trend line. So these guys are just one bad day away from many of them from breaking down. One bad day doesn't mean one day away from breaking down. One bad day means one of those 3% plus days if we get it around current levels. Goldman Sachs, for example, here's our primary trend line right there. We're just cracking above it, but it's not going anywhere because the financials as a sector are holding up. Actually, we're not below it. We're right on the trend line. Look at these two doji candles right on there. So what I mean by one bad day away, a 3% drop, if we get it soon, will put us solidly below that trend line. And the reason I've spent so much time talking about these videos, right now there are so many setups that I have, and I'm going to do the my favorite. If you just want a pure play on the financials and you don't short, you want to buy something, you can do SKF. That's the 2 times short financials. You can do FAZ 3 times short with leverage. But one of my favorite sectors right now is the regional banks, and KRE is that ETF. The KRE chart doesn't pop out too much to me, but a lot of these individual stocks, such as this is the largest by market cap in there, Truist, just beautiful uptrend lines, just right on the edge. So I'm going to do a video on this one covering the individual regional financials and some of them, maybe the bigger banks. We can go to BKX and look at the bank sector ETF. That one's already broken down and back tested. When I go to XLF, that's the financial sector as a whole. It includes insurance companies and brokers. Everything are in there. A lot of stuff, not just banks. When you go to KBX, they're mostly banks, and that's what it is, the banking sector. And then you have, of course, those are including a lot of your bigger banks too. And you go to KRE, these are regional banks. So I'm going to do these separate. And the takeaway will be 2 things as I do each of these videos. If you want to keep things simple, this is what you want. If you want a short exposure on the regional banks, you short KRE. I don't believe, maybe there is a inverse ETF. If I find one, or if anybody knows of one for the regional banking sector, go ahead and chime in on the comment section below this post. Otherwise, this is where you want to trade. And what I like to do is sniff out the most bearish charts within a bearish sector of individual stocks, and then take a handful of those, maybe half dozen of those, and much more often than not, it'll outperform. Those stocks that have the most bearish charts within a bearish sector will fall more than the sector itself. All right, let's not let this one run any longer. We're at 33 minutes, not too bad, considering the amount of charts that I covered. And again, I will follow up with individual setups in those sectors, and also identify some targets for the ETFs for those of you that want to keep it a little bit more simple. ETFs, you have safety in numbers because you're holding a lot. Each ETF holds numerous positions, so you don't have to worry as much about earnings, position gapping against you. And you have that exposure to the sector, but without as much risk as individual stocks. Just as I said I would earlier, loop back to ES. So far, ES is, as suspected, stalling out and look, reversing back below that trend line after just a brief momentum fueled pop above it. We'll see where this candle closes. What you want to see here ideally is a rejection to help validate that trend line, and then that's ES. Let's look at NQ. Similar right there. Here's the downtrend line in NQ on the 60-minute chart. We had a little momentum overshoot of it, red candle so far. Really want to see that reverse, and if so, maybe we'll just take this trend line and just tweak it just slightly like that, something like that. Alrighty, we'll wrap it up here, and I'll pick it up with some other videos with individual trade ideas. This has been Randy Finney with Right Side of the Chart. Have a great day.